Welcome back, options traders. Good morning, everyone. So, what's an acceptable spread when trading options? It's a good question, and it comes to us from one of the traders in our forum. And his question was actually posed: what's an acceptable spread when buying calls? But we should realize that calls are puts are calls. The buyer is just on the opposite risk profile of the seller. So, the more general way to ask the question is what's an acceptable spread for any option strategy? But it's a good question, and it comes up a lot in options trading. Traders wonder, when is a spread too wide? Should I avoid it? Things like that. So let's go find out what is an acceptable spread when trading options. And as always, before we do, please be sure to click like and subscribe. It's greatly appreciated and definitely helps to promote the channel. So bid-ask spread, what's he talking about here? Well, the bid-ask spread is very simply the difference between the bid and ask prices expressed as a percent. So the first problem with this question, asking what's the best bid-ask spread, is a bit like saying, well, what's the best interest rate to pay? Well, the lowest, right? So yes, the best bid-ask spread is the narrowest or the tightest bid-ask spread. Very little difference between the bid and the ask. So, okay, agreed. All things equal, narrower spreads are better. But that really misses the point. So a lot of traders will hear this and they'll say, oh, well, you never trade an option with a bid-ask spread greater than such and such. Well, the problem with that is that you must work with the market you have, not the one you want. The market is the market. There's nothing we can do about it. Sure, there are always ways we can make it better, but that's not within our power. Our job as traders is to say, let's work with the cards we've been dealt, and what are my best decisions given that hand? So let's back up and find out, for anybody who's new, exactly what we're talking about with the bid-ask spread. So we all know that whether we're talking about stocks or options or bonds, markets are a two-sided market. There is a bid price and there's an asking price. The bid price is the highest price that somebody is willing to pay right now. So let's say this is a hypothetical option and we see the bid is 3. Well, I don't really know where that bid is coming from or whose it is, but I just know that somebody somewhere is willing to pay 3. Sure, there's people behind here who are willing to pay $2.95 and $2.90 lower prices, but the highest price right now is 3. Over on the asking side, this represents sellers. So somebody somewhere is willing to sell for $3.50. And yes, somebody behind the curtains there, what's called level 2, will be willing to sell for $3.55, $3.60, $3.65, and on up the ladder. But right now, the lowest price at which somebody is willing to sell is $3.50. So this is called the inside quote. What you're looking at, it is not all of the quotes that exist in the market. And we're looking at the highest bid in the lowest offer. And the difference between these two prices in this example is 50 cents. So sometimes we'll just say it's a 50-cent spread. However, that doesn't really give us the full picture, because if this is a 50-cent spread on a $100 option, let's say that's deep in the money, well, that becomes ridiculously cheap, almost non-existent. If it's a 50-cent spread on a 25-cent option, it's now monstrous. So that's why most traders express the bid-ask spread in terms of a percent. Well, now the question is, we're going to take this 50-cent spread. Should we divide it by 3? Should we divide it by 350? What's the price of the option? Well, we don't really have one price, we have two. Some people say to divide it by the highest price, or over on the ask price. So we could take 50 cents divided by 350 and say it's about a 14.3% spread. But why do we have to choose that number? We could say, let's divide it by 3. So 50 cents divided by 3 is about 16.7%. So you can see it causes a problem. Which price do we use? And the bigger the spread between them, then the bigger the discrepancy in these percentages. So a standard convention, probably the better convention, is to take the midpoint, just the halfway point between 3 and 350, which of course would be 325. And if we take this 50-cent spread divided by 325, we get 15.4%. And so we would say this is roughly a 15% spread. Now, it's not exactly right, but it's going to get you really close if you took 16.7% and 14.3%, added them up and divided by 2. Again, it's not going to be exactly perfect, but it's going to get you really close to 15.4%. So that's what we're talking about when we're referring to the bid-ask spread expressed as a percent. Okay, so with that little background, what happens or what is causing a wide bid-ask spread? Well, many times you're going to see them get really wide. It might be 50 cents wide, $1 wide. You go deep in the money, long dated options, you might see them $5 or $6, $7 wide. So is this market manipulation? A lot of people think so. Not really. There are two main causes for wide bid-ask spreads. The first one is low volume, and the second is high volatility. Now, again, these aren't really the only two. They are the main two causes for seeing these bid-ask spreads getting wide. So let's start with the first one right here for low volume. Why does low volume create a high bid-ask spread? Well, let's go back to a chart here. Let's look at a supply line, which might be our bid, and let's look at a demand line, which could be represented by the asking prices. So what this is telling us is that as the bid prices rise, these are dollars on the vertical right here, as these bid prices go up, the volume goes up. That's why this line here for the bid is sloping upwards to the right. So let's say that a market maker could increase the volume into the market by raising the bid. Or just as traders go out there and start raising the bid, it will generate more volume. That's why that line is upward sloping. The asking price is just the opposite. As people start going to higher asking prices, we can see that the volume drops. So if we have a very high asking price up here, it lines up with a very low volume. If we have a low asking price down here, we can see it lines up with a very high volume. So a market maker can generate volume into the market by reducing the asking price. So we can see that there is a point where the two lines cross, and that is, if you've ever had basic economics, you know that's what's called the market clearing price. At this point, everybody who wants to buy at this price can do so. Everybody who wants to sell at this price can do so. There's nobody left over. We have nobody who feels like, hey, I was willing to sell at an even better price and I never got filled. Everybody who wants to trade at this price can do so. Now, just hypothetically, let's say that that equates to a 1,000 volume, or it could be shares of stock, anything. But that's right where we would see the market clear if we had a single price. But the market is not a one-price market. It's a two-price market. We have two sides. We have a bid and an offer. So we know that the bid is going to be below this price, and the asking price will be above it. So now look what happens when we line up the bid and the offer. See, they don't hit at the X. They hit up here. We're saying at this asking price, we would have this volume, and at this bid price, we would also have this volume. So let's just say that it's at 800. So the first thing to notice from a two-sided market is that we reduce the amount of contracts or shares that are traded. And that's an inefficiency in the market. All right, so when we have a spread between, let's call it the theoretical price, it forces lower volume. Now, also in economics, this is what's called a deadweight loss. It's a loss to society. We have people who are willing to trade at favorable prices who simply can't. And so this is one of the reasons that the market or the regulators like to see the spreads get really narrow, because now we start converging on a single price. We don't have this big red triangle here of wasted trades that never get executed. But what happens if we have even less volume? All right, let's say that it's a lightly traded stock or option, and we don't even have 800 contracts, we have 600. Well, where does that line up? Notice that we're hitting a lower spot on the bid and a higher spot on the ask, right there. And so the bid-ask spread gets even wider. So this is a good graphical representation to show that the main reason for a wide bid-ask spread is not because of market manipulation. That's only going to harm If you want to blame the market makers, they are only reducing their own income by doing this. They're not doing it to manipulate the market in their favor. They're doing it because that's where the market balances. Okay, so again, if you're trading some thinly traded option, and a lot of them are, go out further in time, in the money, out of the money, they tend to get lightly traded, and you will generally see wider bid-ask spreads. Which ones have the highest volume? Typically the at the money. Go do a little experiment and check the at the monies, even going out in time, and they will usually have the smallest bid-ask spread. Go super deep in the money, go out a year and a half, and you're going to see them get very wide. And this is the main reason. All right, so that's the first reason that we see the wide bid-ask spread. The second one is high volatility. So during high volatility, traders usually use limit orders. Now, I know there's a lot of traders that say, oh, you never use a market order. Always use a limit order. Well, that's not really true. They're both tools. If limit orders were always better than market orders, they would just stop creating market orders. There's a reason for using a market order if you need speed of execution. If it absolutely positively has to get executed, and sometimes that's the case, your best choice is a market order. But notice that during high volatility times, traders will lower their bids and raise their offers because they're saying, hey, there's a lot of volatility here. I might be overpaying. Let me shade my bid a little bit. I might be selling it for too low. Let me raise the offer. And what does that mean? Lower bids, higher offers? It means the bid-ask spread widens. So whenever you're using limit orders, you have to realize there is a risk. It is not free like everybody thinks. Limit orders aren't reflecting new information. Traders and algobots can quickly pick off those orders upon the arrival of favorable information. You're not going to be able to get in there and cancel those orders fast enough. And so it turns out, this is just an interesting way of looking at limit orders, that limit orders provide free options to other traders. Well, why is that? What do you mean that they're free options? Well, let's go back to our bid of 3 offered at 350. Let's say that you want to place an order to buy at market. All right, some new information comes in. You've got to get this trade executed. Notice that whoever it is that posted this asking price of 350 has the obligation to sell, just like somebody who sold a call. It's an obligation. But how much did they get paid to place this limit order? 0. It's a free option. On the other hand, let's say that you want to sell at market. Some new information hits the market and you want to sell. Well, the current bid is 3. So whoever placed this bid has the obligation to buy. So I can quickly change my decision to say, I've got to sell. This person isn't going to have that same luxury. He's going to get picked off immediately. So he has the obligation to buy, which is similar to a short put. But you can get paid for a short put. How much did this person get paid for posting a bid? 0. So again, you can see that whether you're on the bid or on the offer, these are limit orders, that you have posted free options to the market. Now again, it's more of a way of looking at limit orders, but with that in mind, think about what happens if volatility increases. So if you're selling calls or puts and volatility increases, how would you adjust your strikes? Well, chances are you're going to say, I don't know if I want to bid 3. Let me lower it. Maybe I'm going to make it 250. I don't know if I want to sell for 350. I might be selling it for too little. Let me raise it to maybe 4. And look what happens. You have widened the bid-ask spread. So this is another reason why bid-ask spreads get wide when you have high volatility and especially if you have low volume stocks or options. So another mistake that traders make is they might look at this bid-ask spread, bid 3 offered at 350, and they'll say, oh, well, the fair value is at 325, the halfway point. Let me post a bid or an offer at 325. Well, you have to understand the mid price isn't a market. It isn't a price at all. It's just an average. It's the midpoint between 3 and 350. There's nobody out there in the world bidding 325. There's nobody offering it for 325. It's just a mathematical calculation. So why do so many traders say to trade at the mid? Well, there can be some benefit, and here's what will happen. If the bid is 3 offered at 350, and let's say you want to place a bid, you're a buyer, and you go, I don't know if I want to pay 350. Let me place it at the mid of 325. What happens to the quote now? Remember, it's at 3 to 350. The quote immediately goes 325 to 350. So this is your order sitting there on the bid. And notice what happened. It used to be a 50-cent spread from 3 to 350, and now it's been reduced to 25 cents. But notice that you're the one that reduced the spread. And so you've given somebody the incentive to sell. And you have to say, if nobody else was willing to pay 3, is it really necessarily a great thing that you got picked off at 325? This might be the winner's curse. You might have paid too much. And another illusion is that if you get filled at 325, it's not necessarily because that was the fair value. It's probably because the market fell and 325 now maybe became the offer. So on the other hand, let's say that you're willing to sell. Current quote is 350, and you go, I don't know if I want to sell it for 3 down here on the bid. Let me place it at the mid of 325. What happens to the quote now? Well, now the bid is still going to be 3, but the asking price is going to change. It's going to get reduced from 350 to 325. So this is you sitting on the asking price. Once again, if the rest of the world isn't willing to sell for less than 350, did you really do yourself any favor by making it less and go to 325? Also keeping in mind that these are free options. But what you did by placing this sell order at the mid is you have, in fact, reduced the spread to 25 cents. So as I always tell traders, if you think that there's something wrong with this wide spread, feel free to tighten it up. You can certainly bid 325 or offer at 325. You'll do the market a very big favor and reduce that spread. But again, if nobody else is willing to do it up here, is it really a big benefit to think that you've pulled off some kind of a fast one by trading at the mid? Probably not. So just remember, whenever you see wide bid-ask spreads, it is mostly a function of low volume and or volatility. But that shouldn't drive your decision to trade. If there is a trade that you're trying to do, you have to ask, is the asking price an acceptable number? The bid is really irrelevant. You're a buyer. And if you're a seller, is the bid an acceptable price? Doesn't matter what the asking price is. You've got no control over either of those. So you have to say, is the bid an acceptable number to meet my goal and to execute this trade? Is there some type of a pricing discrepancy that I have perceived that makes that a good price? But again, the width of the spread shouldn't really be the sole reason for deciding to trade. You can always avoid the spread by not entering the position. So that's why it's really wrong to say, oh, you should never trade it. Well, that's always true. You can always do that, but then you've missed a lot of the opportunities. Instead, ask, are the prices acceptable to reach your goals? More importantly, once you're in a trade, learn to hedge, roll, and morph the positions to manage the risk as new information hits the market. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a candlesticks and technical analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.